Breaking news in the last few moments, the Bank of England has announced that interest rates have been held at 3.75%. Interest rates have been held at 3.75%. That was expected by most analysts. The current rate of inflation at 3.4%. Analysts expect a further one or two cuts to interest rates in due course this year. Just looking at the split of the Bank of England Monetary Policy Committee, 5 members voted for the hold, 4 members voted to cut that rate from 3.75. So a split between the Bank of England Monetary Policy Committee. We will hear from the Governor, Andrew Bailey, at 12:30 this afternoon. But for the moment, I can tell you the breaking news: the Bank of England has held interest rates at 3.75%.
Hi, everybody. Welcome. Thanks for being here. Welcome to the February Monetary Policy Report press conference. With us today, we have Claire Lombardelli, Deputy Governor for Monetary Policy, Dave Ramsden, Deputy Governor for Markets and Banking, and the Governor, Andrew Bailey. Andrew will begin with opening remarks, and then we'll turn to questions.
Well, thank you, Katie. My main message today is one of good news. Disinflation is on track and looks to be ahead of the schedule that we expected in November. CPI inflation has fallen from 3.8% in September to 3.4% in December, which is a little lower than we expected back in November. And we expect inflation to decline further to about 3% in January, February and March, before reaching a level close to the 2% target from April, and we think then staying there. So that point of reaching near to the target is about a year earlier than we expected when we were last here back in November. As inflation has fallen, we've been able to ease our foot off the brake, making monetary policy less restrictive by cutting bank rates 6 times, including at the meeting we held in December. Recent developments provide more confidence that inflation is on track to return to the target soon. But we need to ensure that inflation falls all the way back to the 2% target and stays there. So today we've held bank rate at 3.75%. Now, despite all the uncertainties in the world, and we don't underestimate those, we are not currently facing a situation in which monetary policy is being hit by big new shocks. The world economy was more resilient last year than we had expected. So our course remains the same. It's to get inflation to the 2% target and for it to remain there and to put the big external shocks that drove inflation up behind us. This means that with inflation returning to target, there should be scope for some further easing in monetary policy. But risks remain, and the MPC's policy decisions will be shaped by how they unfold. On the one hand, the period of high inflation could have affected the way wages and prices are determined in the economy, creating more persistent inflationary pressure. On the other hand, weaker labour demand and subdued household spending could push inflation further down. Monetary policy is being set to balance these risks. So I will now turn briefly to the near-term outlook for inflation before setting out the 2 key policy judgments underpinning our approach to setting interest rates. Chart 1, which has just come up, shows 12-month inflation in this Consumer Price Index since the start of 2024. That's the white line, along with its components. Those are the coloured bars. CPI inflation remains above the 2% target, reflecting in part unusually large increases in administered prices and food prices. Elevated labour cost growth has also pushed up inflation, particularly for services, which remain the largest contributor to headline inflation. That's the yellow bars. But the shaded area in the chart shows how we expect inflation to fall to a level close to the 2% target in the second quarter of this year. A fall in the contribution of utility prices represents around 1/3 of the overall expected decline in the first 6 months of this year. A reduction in the contribution from other administered and regulated prices and indirect taxes is also expected to support the fall in inflation towards the target. And the fall is further supported by a broad-based slowing in cost pressures, including from lower wage growth and a fading impulse from last year's increase in national insurance contributions for employers. Overall, the fall in second quarter is 0.7 percentage points larger than we had expected in the November report. As Chart 2 shows, that news largely reflects the energy measures announced in the budget, which, alongside a fall in wholesale gas prices, is expected to result in a decline in the Ofgem price cap in April to just over £1,600 from the current level of £1,758. While we can now be more confident that inflation will fall back to around the 2% target in coming months, monetary policy needs to ensure that inflation will stay close to the target sustainably. So that takes me to our first key policy judgment, that the risk from greater inflation persistence has continued to become less pronounced, while some risks to inflation from weaker demand and a loosening labour market remain. The recent experience of high inflation could still be affecting wages and prices. This could create more persistent inflationary pressure, requiring tighter monetary policy than otherwise. Services price inflation and wage growth still need to fall further for the MPC to be confident that inflation will return to the target and stay there. In addition, weak productivity growth could put upward pressure on companies' costs. But the evidence suggests that this upside risk to inflation has continued to diminish. Lower inflation in coming months should feed through into lower inflation expectations among households and businesses, reducing the risk that inflation expectations will add further to inflationary pressure. And while wage growth may only be falling slowly, new bank staff analysis provides reassurance that structural changes in wage setting will not keep adding to inflationary pressures. As Chart 3 shows, annual private sector regular pay growth, that's the blue line, slowed to 3.6% in the 3 months to November, down from 4.4 months in the 3 months to August, and a little below our November projection. Looking ahead, the Agents' Pay Survey, that's the pink diamond, suggests that pay settlements will average 3.4% over this year, down from 4% last year. With a looser labour market and falling inflation supporting a fall in inflation expectations, we expect actual pay growth to fall somewhat below current expectations for pay settlements, to about 3.2% by the end of the year. That is close to bank staff estimates for a level of pay growth consistent with the inflation target. Supported by the cooling in labour costs, we expect services price inflation to ease from 4.5% in December to 3.3% in June. Risks to the outlook for inflation from weaker demand and a loosening labour market do remain. Labour market conditions have loosened further, and bank staff estimate that underlying employment has been flat over the past year. The rate of unemployment has risen to 5.1%, and measures of recruitment difficulties have eased. While the bank's agents report that firms are managing headcount mainly through natural attrition, the redundancy rate has ticked up in the official data. UK economic activity remains subdued, especially in market-facing sectors. Bank staff estimate that underlying GDP growth, abstracting from volatility in the headline measure, was 0.1% in the fourth quarter of last year, slightly lower than both headline GDP growth and estimates of potential supply growth. Contacts of the agents continue to expect subdued growth throughout the year, citing weak confidence and subdued global demand. In the central projection, GDP growth is expected to strengthen to nearly 2% a year by 2028, underpinned by recovery in consumption and a strong housing market. But there is a risk that consumption growth will be slower than we expect. despite past reductions in bank rate, the household saving rate remains above historical levels. Now, that could indicate that household spending growth will remain weak as households are more cautious following the recent shock to their finances. In turn, weaker demand in the economy could further weaken the labour market with larger rises in unemployment. Spare capacity could build to such an extent that inflation could settle below the 2% target unless monetary policy is loosened further. That said, there are also upside risks to inflation in the period ahead. The near-term fall in inflation might not affect inflation expectations and through that wage growth to the extent that we expect. There may be less slack in the labour market than our current estimates suggest, and structural changes in wage and price setting could still assert themselves. And productivity growth may disappoint relative to our expectations and generate greater inflationary pressures. But overall, concerns about upside risk from greater inflation persistence continue to become less pronounced, while some risks from weaker demand and a loosening labour market remain. That takes me to the second key judgment, that, based on the current evidence, bank rate is likely to be reduced further. But judgments around further policy easing will become a closer call. As always, the extent and timing of further easing in monetary policy will depend on the evolution of the outlook for inflation. On the one hand, cutting in bank rate too quickly, or by too much, could lead to inflation pressures persisting, requiring policy to change course. On the other hand, waiting too long to ease policy could come at the cost of a sharper downturn in activity and subsequently inflation, requiring greater policy easing to ensure inflation returns sustainably to a target. The central projection described in the Monetary Policy Report provides a reasonable baseline for how the majority of the MPC judges the economy is likely to evolve if neither of the remaining risks around inflation persistence and demand weakness materialise to a meaningful degree. As shown in Chart 4, in the current 3-year projection for inflation, which is conditioned on the market path for interest rates, inflation falls to around the 2% target in the second quarter of this year and then remains close to that rate over the forecast period. The effect of the budget measures on the central projection is shown in Chart 5, along with underlying drivers of the deviation from target of our medium-term projection for inflation. The contribution from administered prices and costs related to national insurance contributions are assumed to dissipate in the second quarter of this year. That's the blue bars. Lingering second-round effects on wage and price setting from the big global shocks of recent years, that's the purple bars, also fade and largely dissipate by the middle of next year. In part, reflecting the restrictive stance of monetary policy, a margin of slack widens a little further in the near term and weighs on inflation throughout the forecast. That's the green bars. While monetary policy continues to weigh on inflation and activity, with the progress that we've made on disinflation, we've been able to make monetary policy less restrictive. And if the economy and the outlook for inflation evolve as we expect, there should be some scope for further easing in monetary policy in the period ahead. But for every cut in bank rate, how much further to go becomes a closer call. As always, the MPC remains squarely focused on our remit to return inflation to the 2% target sustainably. So with that, Claire, Dave and I are happy to take your questions. Thank you.
Let's go Sam and then Helia, please.
Financial Times. There have been some activity indicators, particularly PMIs, which have been a bit stronger of late, but you don't seem to be putting any particular weight on that. Indeed, the outlook is very subdued, as the minutes suggest. I wondered why you're not seeing any more promising signs from those activity indicators. And given the very weak outlook, and given you have inflation below target on both a 1 and 2 year horizon, why aren't you cutting today, or why was there not a majority in favour of a cut as soon as today? Thanks.
Well, I'll start off. I think on activity, it's interesting. You're right. I mean, there's a bit of a tension in there that The surveys are beginning, as you say, Sam, to show some signs of an uptick. On the other hand, as you'll see from the report, the message we're getting from the agents, I mean, they use the word lackluster, I think. So now, let me put that into context, because, we've been going through a lot of years of very big shocks. I would describe this sort of tension in the data and the evidence as sort of something that's, quite usual, actually. I mean, in the very short run sort of view of the government. But of course, we'll be very focused on it. I don't want to say usual in the sense that we're not in any sense focused on it. It is something we will be looking at very hard in the next meeting, and no doubt the ones after that. So there is a little bit of a puzzle in there, I think, which we'll be seeking to solve. Now, on the question of why not cutting, I mean, first of all, I would say that obviously, as you can see from the chart we've got in front of us, inflation does dip below target on the central case, but it actually, it's only a small dip and it comes back to target. But actually, the bigger point I'll make at this point is that we, because you asked the question rightly about how that conditions our judgment today, we need to see this pattern emerge, and we need to see more evidence, in my view, that we're going to get this sustainable return to target. And that really is an issue about what I call underlying inflation. We've got obviously quite a few things going on, which, as this chart shows, are special measures. Just as, by the way, we had that last year when we had what we tended to call the hump. That's the data, not our feeling towards it. And we are seeing that now in wine. But we have to be very focused on the underlying story, because that's what, in the absence of, of shocks to come, which we don't know about, that's what's going to determine this path. Thereafter, we ought to add anything to that?
No, nothing else going on.
I mean, the only thing I was going to say, although that, there's been a vote this time, and we voted in different ways, and you can read about that in the paragraphs. We're all balancing these two risks to underlying inflation, as Andrew emphasised. So, for some of us, there's still the worry about persistence, that inflation won't settle at the target, but will stay above it. And for others of us, the downside risks are more apparent, so the worry is that inflation will actually settle below target. But we're balancing those two risks, which has really been a pretty consistent picture.
I would say if you look at that picture of mixed data is true across the data sources, survey, more administrative data, what we're hearing from the agents, those sorts of things, but also actually kind of within types of data. So if you look at the wages data, for example, there's some indicators that are stronger, some of the surveys, some of the more estimates based more around the relationships we've seen in the past are a bit weaker. So you're not just seeing, it's not that each category of data, they're not consistent with each other, but also within, there's quite a lot of a mixed picture, which in a sense gives you the sense that, there's not things strongly one direction or the other at this point.
Helia, in the middle there.
Helia Ibrahimi, Channel 4 News. Just to underline that, really, because people at home will watch you saying this is good news, that we are going to hit our inflation target in April, and they will be thinking, well, hang on a moment, why don't you get on and start cutting, especially when unemployment is going up and growth is slowing. At what point do those risks become more dangerous for the wider economy?
Well, it is good news. I mean, this picture is good news, but there's a lot of assumptions lie behind this picture. Not so much in the short end, the left-hand side of it as we're looking at it, because a lot of that, as I say, is measures that have been announced. But our job is to keep it sustainably at target, and there are a lot of things that we need to see evolve for that picture to be as it is in this chart. Now, I think it is good news. I'm optimistic. But certainly, I'll speak for myself. I need to see some more evidence that we're on that path before we could make another cut in rates. And let me give you one illustration of that, which is a bit more concrete. We have got expectations of inflation which do remain elevated, both in households and businesses. Now, I would expect, based on patterns of history, that as we start to see, and it comes through in the data, this this pattern of inflation coming off. And we do expect some of that to be seen in the next release, actually. We do expect it to move down in the next release. You can see that on the very far sort of left-hand side of the shaded part. That will feed through into expectations, because that's the way it normally works. And that is something that will certainly give me greater confidence that we're on track. And that's what we think we need to see to take any further step at this point. So that's what I'm waiting for. But you'll see in the paragraph that I wrote that I expressed it very much, is that as I go into the next meetings, that will be the question I'll be asking myself.
And I think it is important. The reason we put this chart up and we're emphasising what's going to happen to inflation, not so much in the very short term, but where inflation is settled, is that is our remit. So we're very conscious right across the committee that unemployment is now above 5%. That's 1.8 million people. But we have to think about what is the impact of what's going on with subdued activity with the labour market on inflation. So we're balancing those risks around inflation.
Paul, up at the back there, and then Sue.
Paul Kelso, Sky News. Governor, too, if I may, you say further rate cuts are now likely. Is the message to borrowers, homeowners, mortgage holders, this is now a question of when, not if? And a second question, if I may, away from today's decision. We've seen revelations in recent days about Peter Mandelson's conduct while business secretary, his contacts with Jeffrey Epstein, the sharing of sensitive information with financiers at a time when governments and indeed central banks were working to deal with the fallout from the financial crash. You were at the Bank of England at the time. Have you got any reflections on that conduct and what risk, if any, it posed to the stability of the financial system at the time?
Well, those are two very different questions. On the when and if question, I think that, the view I just reinforced, having Vincent's comments I've already made, that I do expect, and as I put in my own paragraph, I do think that it is likely that we will see some further move down in rates. I would emphasise the points I made in the opening remarks, that as we get closer to what you might call the sort of the neutral rate, though there is quite a lot of uncertainty as to where that is, these decisions become a closer call, because that's this is the question of what's the rate that will essentially settle in, absent further shocks. What's the rate that will cause this profile to settle at target, which obviously is where we want it to be. So there's a lot of uncertainty there still. But my central view, as I said in my paragraph, is reasonably aligned with the picture we've got in front of us. For me, it's then waiting to, I do need to see some more evidence, as I just said a moment ago, that is evolving. Well, look, I'll turn to your second question, Paul. I am shocked by what we're hearing. You probably remember that around a year ago I had to go and give evidence in a legal case involving this whole issue, dating back to my time at the FCA. I'm afraid all I can conclude is that I was obviously very happy to do that. It's my duty. That again, it was having to sort of, in a sense, push back on the lies that we were being told consistently. I am shocked by what we now learn about what went on during the financial crisis period. But look, let me just offer two reflections. And one really reinforces what I think the Prime Minister said this morning, that the most important thing in all of this is the victims. Everything else is obviously things that necessarily must be gone into, but we must not forget that the most important thing in this is the victims in all of this. The second thing I'll just offer, and I think this is, if you don't mind me saying, I don't want to sound pious, but this is for all of us. How is it that we live in a society in which this happened? And the cover-up happened as well. I mean, those are questions that we all have to ask, which, I think that is a very fundamental question that we have to ask ourselves.
Sue.
Thank you. Sue Chan from The Telegraph. Governor, could you just reflect on what you think the employment rights bill will affect the jobs market, given it will bed down over your forecast horizon? And yeah, how do you think it will affect the jobs market?
Well, we get quite a lot of, obviously, input when we talk to our contacts and when our agents talk to the contacts around the country. I think there is still a fair amount of uncertainty about how that is going to shape up. So we will continue to watch it carefully. I don't know if you want to add anything.
Yeah, I mean, I think we talk to our agents a lot about this, and they talk, hear about it from firms, because actually the details, firms are waiting to see the details to be able to turn that into decisions about what they will do. But obviously, we've had quite a lot of information and intelligence from firms about some of the other changes that we've seen over the labour market over the last couple of years, and we've been increasing, if you like, we've heard a lot about that, and we've done a lot of analysis of it. You can see some of that in some of the stuff we put out today, actually. But in terms of the employment rights bill in and of itself, I think until there's more detail, we won't be able to understand. It's not reflected in your forecast at the moment, is that right? That's correct, yeah.
Joel, and then Ritika.
Very much. Joel Hills, ITV News. I also have two questions. Governor, you said that all being well, there should be further scope for cuts, and that future decisions will also become a closer call as we edge towards neutral. Markets are currently pricing in 2 more cuts, which would take bank rate to around 3.25%. In your view, would that be a sensible level to pause, to reflect, to assess the impact before fine-tuning? And my second question, really to pick up, I think, on what Paul asked you just, questions are being asked about the Prime Minister's judgment in light of the email disclosures and the correspondence between Peter Mandelson and Jeffrey Epstein. Do you see any evidence at all that the political uncertainty is affecting either the pound or UK gilts?
So I'll take those two in turn. First of all, I mean, going back to the chart we were just looking at, which has gone off now, that has the market, that as it was always uses the market curve as the conditioning assumption for the path of interest rates. As you say, there are about 2 cuts priced, so 50 basis points priced into that curve. Now, I think you're subtly trying to sort of say is 3.25 the neutral rate, or even is it R-star even? Now, look, there is uncertainty around the neutral rate. I think we've said before, it's probably in the range 2 to 4%, but you could reasonably say to me, saying that's really helpful, but that's quite a big range. So what I would say, go back to saying this, I think this is a reasonable profile to have at the moment. So I think the curve is in a fairly reasonable place. It certainly fits with my thinking in this decision. But it doesn't condition in any precise sense either the timing or the scale of any future moves, because that will depend on how the evidence emerges. What I would say is, I'll just reiterate a point I made a few minutes ago, Joel, because I think it's an interesting one, that we are coming to the tail end of the very big shocks that we've been seeing. And as I said in my introductory remarks, in some of these bars wearing off, particularly the purple bar, the persistence judgment bar on this chart, that is the wearing off of the past shocks. Now, if the world then evolves, as it looks here, and with that, we can't predict, of course, what shocks might happen that none of us know about today. We are moving into a more settled world, where the sort of thinking that you were outlining about, where might the neutral rate be becomes much more relevant. So I'm not going to endorse 3.25%, but I think it is a reasonable sort of market curve at the moment, but we'll see where it ends up. But I think that's the best thing to say at the moment. Look, on the second question, We saw some market movements this morning, but frankly, the gilt curve last time I looked, which was just before we came into this room, has actually retraced its steps, and it pretty much retraced its steps before our announcement. Our announcement hasn't moved it much either. And I would also add that all market conditions this morning have been entirely orderly.
And just to reinforce that last point, I mean, there'll always be a question related to market movements at our press conferences, whatever's happened. I mean, when you think about the other things that were happening this morning, we've got a decision to make that's now out there. The ECB's got a decision to make. There will be speculation and positioning about what we were going to do, what the vote was. The movements in yields today, the last time I looked, the UK 10-year yield was at 4.57, so that's up 7 basis points from the start of the year, and it's exactly the same as it was at the start of 2025. So, we're seeing movements in a very narrow range at the moment, and there are things happening all the time. Last spring was when we saw the really big movements, actually in response to the US announcements on Liberation Day. That was when that was the period during which we were looking more at how much volatility is there, are things orderly, but what you're seeing today is tiny in perspective.
So it's Ritika along there, yeah, and then Phil.
Ritika Gupta, CNBC. Governor, you mentioned in your remarks there about the risk of potentially going too far with rate cuts, and whether that means that the Bank of England would have to change course. So I was wondering if there is any scenario that you actually have to hike rates over the next 18 months, and if there's any kind of probabilities that you can attach to this, and also what your views are on the associated reversal costs of that.
Well, I think I can say that we did not discuss hiking rates at the meeting. That was not on discussion. But you can see that we're using the scenarios, and obviously we've talked about the scenarios again in the report, and it's very important because the scenarios that we're using and that we're describing are very much the ones that help us to make our decisions. There's been a bit of outside commentary, I know, about are these scenarios sort of too near to the sort of the centre, and that's a reasonable debate to have. It's a completely reasonable debate to have. But what I would say is these are the scenarios that we actually spend our time talking about in the meeting in terms of thinking about how to take the decision. So I would come back to very much putting it in the context not of hiking rates, but to what extent there is scope for for further easing in rates. And just re-emphasise the points I made in my opening remarks about, if we were to see rather more continued persistence than we think we might see, then obviously we'd be looking at a somewhat different scenario, but not particularly the hiking. So we'll not be looking at a hiking scenario.
I mean, the only thing I would add to that is probably, in a sense, to reiterate what the governor's been saying, that where we are at the moment is in a process of the economy, in a sense, normalising after a series of very, very large shocks. In the next 18 months, who knows what else could hit the economy? And of course, if there were shocks that required monetary policy action, we would respond to them. But that's quite different from thinking about actually how is the economy operating now, understanding that as best we can, and ensuring that we're setting policy for the economy now and what we expect over the next 2 to 3 years.
Yeah, I mean, I just want to reinforce the point I made earlier, which is, over the last year, the global, events and shocks and news that we've had have actually had less effect on the world economy than we thought they would. I mean, that's interesting and quite evident now.
Phil Aldrich and then Jerbo.
Thank you. Phil Aldrich at Bloomberg. Market participants that we speak to are saying that the biggest sort of risk to the economy or to derailing growth this year and to sort of market stability is the Labour leadership election, Labour leadership turmoil that we're facing. I just wondered whether you agreed with this assessment of the risks or whether these people in the markets are completely overdoing it. And just secondly, in Europe, we've got interest rates at 2%. Here, they're 3.75. Why are they so much higher here?
I'll do the first bit. I'll get Claire to come in on the second one. Well, first of all, I'm not going to comment on politics at all, as I hope you would well understand. The But let me make one point, which is not commenting on politics, but is just commenting on your point about market reflections on where the risks are. I mean, I would just come back to this point and looking at the chart we had in front of us a few minutes ago, that if you look at the inflation that's back. Thank you. The left-hand side has some, has things that are, are pretty much baked in because they've been announced. They're measures that are in the pipeline. The big part of the chart is obviously the projection part going sort of into the right-hand side. And that is being driven by, underlying economic developments, the underlying state of the economy. So I would just make one observation. I think whatever happens in politics, and I say I am not going to comment on that for obvious reasons, what is much more important here is what goes on in the underlying economy.
Sure. I mean, I would say we've got a whole chapter on different risks that we talk through in the NPR, which are the risks as we see them to inflation at the moment in the economy. On this question of our rates and European rates, I mean, you're right, look, they're in different places. That reflects the fact the economies are very different, both structurally and in terms of where they are in the cycle. So, we still have inflation at 3.4%. It's on this path down, as we've talked about. We've still got underlying inflation and those pressures that we need to continue to see and to squeeze out of the economy, that we're in a slightly different sort of cyclical place than the European economy, so you'd expect rates to be different. There's also other structural things that are different in the economy. Supply is quite different and supply capacity is quite different in the European economy than it is in the UK. We talked about this a lot, that's obviously well known. And then there's some other longer term trends and underlying factors that again are very different. So for example, demographics is playing quite a different role in Europe than it is in the UK, and we face slightly less sort of demographic pressure than they're facing. So all of these things will drive, all these different factors drive the difference there. Also the sort of external sort of financing position, again, very different. So there's a lot of similarities in some ways between the UK and Europe, but a lot of quite fundamental differences as well.
I just reinforce that, Phil. I mean, let's assume that everything evolves as this chart suggests it will. Then that is good news from the point of view of macroeconomic policy. The issue then becomes, as Claire has rightly said, the supply side of the economy and raising the potential growth rate. And that's down to structural measures, not obviously what monetary policy does.
And I just wanted very briefly to provide a bit of context around Andrew's response to your first question, which that was focused on the monetary policy aspects. I mean, this is a monetary policy press conference. Back in December, we published the financial policy report. Andrew and I gave quite extensive evidence to the Treasury Committee last month on that report. That details what we see as the main risks to financial stability, and it is quite a long list. But those are the tail risks, whereas today we're talking about more, the most likely outcomes. But there are a lot of potential risks out there, which market participants would also recognise, I think.
Deirdre, right behind you, and then Jeff.
Derval Jordan from BBC News. Does the Bank of England still have 31 metric tons of Venezuelan gold? Sorry, is it working? Hello?
Yeah, it was
Right. Does the Bank of England still have 31 metric tons of Venezuelan gold in its vaults? Have you received any new requests from the interim president of Venezuela or from the US after they've seized Maduro? And if so, what's your course of action?
I can let you into a secret. Dave was actually looking forward to answering a question on gold, so well done. And Dave.
We don't. It's very important. We have a very significant gold custody operation, and that is carried out as you would expect under conditions of great confidentiality because our customers don't want details to be revealed. However, because the Venezuelan gold is in an ongoing court case, we can say something about it. It is a fact that we have some Venezuelan gold. but the facts that are as set out in the court proceedings are as far as we can go on that. What I can give you is a bit more general context, if of interest. We've still got just over 400,000 gold bars in the vaults, which are, that's many hundreds of billions of pounds sitting under us now, depending on today's price. We have seen over the last many months, much more business. What do I mean by that? In terms of the physical movement of gold, a busy month would be about 8,000 individual movements, and that reflects the fact that we are, I think in terms of the gold that's held in the London market, we're custodians for 60% of it. So there's a lot of movements reflecting, desire to bring that to market, or because we've got customers either moving their gold out or in. I think the only additional bit of colour I can give you is that January was a very busy month. And we'll publish in the next day or two, we'll publish the weight of all the gold we've got. I think we do it 5 days after the end of the month, so look out for that stat. I just said that we don't say anything about our customers individually. We just give sort of headline or macro numbers.
Jeff, Jeff and then Jack.
Hi. I'd like to pick up on a speech that Megan made a couple of weeks. A speech that Megan Green made a couple of weeks ago about saying that the impact of a loosening of US monetary policy would be more likely to loosen financial conditions and have pro-inflationary consequences here. Did you discuss that speech this morning, and is it at all justified to think of that as a consensus position on the committee, or is that still very much a personal view?
Well, I don't think Megan was actually making a prediction as to what would happen to US monetary policy. I think she was saying, she was trying to illustrate a point about the relationship between US monetary policy and then the feed through to an open economy like the UK. So it wasn't in any sense a prediction. We don't make predictions about what the Fed will do. But I think it's entirely valid to say, for an open economy like the UK, what do we currently think about the pass-through and likely impact of US monetary policy?
And secondly, if I may, and forgive me in advance for being provocative here, it took you the best part of 9 months to work out that Rachel Reeves's first budget was going to be pro-inflationary. It's taken you less than 2 months to work out that this one will allow you to keep cutting. Do you need to check your biases a bit? Because the effects of both budgets were pretty mechanical. And although you can say that in the first budget, the effects of inflation were going to be indirect because they depended on the reaction of the private sector. I mean, it was fairly clear from earnings calls and from your agents, I think, that the private sector intended to put prices up in reaction to the first budget. So how is it that you were kind of quicker to respond to this one than to the last one?
I don't think that's right. Both budgets were, one was a bit earlier in the autumn, but both budgets one was towards the end of 2024, one was towards the end of 2025. And we, as you recognise, we had to take account of the behavioural effects of NICs, but in the February 2025 forecast, we were publishing a very significant hump in inflation, which included the impact of NICs. Yeah. So, and as Andrew flagged in an earlier comment, what we're seeing this year is a slight mirror image of that, but that hump was very clearly in our forecast from last February. So I'm not sure what your lag is referring to.
Just to add on this point, because I think it is relevant, the it was quite far from mechanical in a sense what the impacts would be. And actually we've got a really, I think, lovely chart in the agent's survey of business conditions that shows that even firms who, what they plan to do in response isn't actually what they did in the end. So, in a sense, far from mechanical, it was going to depend on a whole set of things, including, the labour market, wider expectations and the like. So I think we sort of did factor it in, but I think we also have to recognise that it was uncertain, including to the actors themselves.
Jack, and then Heather.
Thank you, Jack Bardick from The Times. I suppose just developing on that budget point, maybe a better way of phrasing it is, has it made it more likely that you're going to cut interest rates in March and April? And then possibly one for you, Dave. You obviously mentioned the gold. We've had a conversation about the gold market there. Are you concerned about how sharp the swings in the market has been over the last couple of weeks? We've seen silver and gold prices fluctuate wildly. How concerned are you about that?
Well, the first question, thanks. Look, I think that, as I said in my opening remarks, the fact that the point at which we come back to pretty much to target, and when I say pretty much, I mean we're talking about 0.1s then, by almost a year, is obviously significant. No question about that. The two things that I would just reiterate again are, one, how that passes through into expectations. Now, all the evidence would suggest it will. All the evidence would suggest that there is quite a tight link between actual inflation and particularly short-term inflation expectations, but we haven't seen it obviously happen yet. But the bigger point is just to come back to this point about underlying inflation, because going back to the chart that we had, that's the thing, and particularly services inflation, that is going to really determine whether we stay sustainably at target, and that's what we have to do now. I mean, it's important to talk about the very short term because it is the thing that will actually, say, take us back to target. But monetary policy has its influence beyond that. When we take these decisions, we're looking beyond that. It's about this question of sustainability.
And just on this question of movements in gold prices, I mean, it does actually, I think it's useful context to say that this was a subject that came up when Andrew and I gave testimony last month, because the one safe asset that has been very obviously behaving in the way that you might expect given all this uncertainty has been gold. The price has been consistently going up for a variety of reasons. So that, in the sense, therefore, when you get what is perceived as some news, it's not necessarily surprising that it moves quite significantly in response to that. And then you start to get volatility in it as, there's different perceptions of whatever's been said by whoever or whatever geopolitical event has taken place. So it's not, in a sense, back to what we always say to you, which is that, we often talk about government bond markets, but we obviously monitor all the key markets, including, the key commodity markets, including gold, even though gold is obviously a very unusual market in some respects. And so we have seen that very pronounced volatility compared to normal, but in the context of just how much of a safe haven gold has become, personally, I'm not that surprised that we've seen that volatility.
The characteristic of gold is that it's agnostic as to nation states. Yeah. That's the...
Heather, and then David.
Heather Stewart from The Guardian. There's a box in the report about AI and the impact potentially on productivity, and it suggests that UK companies seem to be quite enthusiastic adopters of the technology, but that we can't yet see that in the productivity data. What about the jobs picture? There's been a lot of commentary about the suggestion that adoption of AI may bear down on employment. We may see job losses and slower hiring. Are you anecdotally hearing that? Is there anything in the data to show that? And are you expecting it to come through in the coming months?
Well, I'll start off. I mean, I think, first of all, I won't put my economic historian hat on for too long, but just bear with me for a moment. No, it's not. I mean, there will be a lag between whatever take-up there is of AI and whatever pass-through there is to productivity. That's the lesson, from other big general-purpose technology innovations over history. So there's the famous sort of, it took sort of 30-odd years between Edison wiring a light bulb up and it coming up in sort of US productivity numbers. There's the famous, I think it was Bob Solow, comment about you can see ICT everywhere except in the productivity numbers. So that's something I think we should sort of start off by expecting. What I would say on employment is, and I'll just advertise quite a nice piece that one of our colleagues has done that we published in Bank Underground quite recently, is that there are a number of employment effects that come through, some of which are, take it down and some of which are, take it up, actually, in terms of creating new activities. There is also then probably a different timing profile of those effects coming through. Certainly anecdotally, when we go around the country, when our agents talk to contacts, I think we are seeing evidence probably of reduced hiring in some activities. And, you're writing stories about it, all of you are writing stories about it as well, in terms of some activities where hiring's gone down. Some of that is probably due to sort of broader economic conditions, but some of it may be beginning to be reflective of AI.
David and then John Paul.
David Milliken from Reuters. You're talking a bit more about sort of wanting to see sort of more evidence sort of before sort of you sort of make a decision on sort of whether to cut rates. I was wanting to get a sense sort of how long that evidence is likely to take to build up, whether it's something that you can only really make a judgment about when inflation has fallen back to 2%, and sort of whether sort of expectations have moved as you'd expect by that point, or whether we're more in a situation like, say, in November last year, where sufficient evidence for a cut could build up in time for a next meeting. And then just secondly, you've talked a lot in the past about the importance of central banks sort of independence. Are you sort of reassured by the fact that it's sort of Kevin Walsh who's been nominated to be the next sort of chair of the Federal Reserve?
Well, I'll take it as in reverse order because I can do the second one very quickly. Actually, look, I welcome the nomination of Kevin Walsh. I've known Kevin for a long time, so I welcome it. Kevin is somebody I know very well. And by the way, look, I entirely separate, things that I've been said and been involved in the context of Jay Powell and things to say about Kevin Walsh. This is not a Jay versus Kevin thing. They're both people I know both of them very well. They're both very qualified. On this, your first question, David, is a really good question, obviously, and it will be, I think, the focus for me certainly of the next meetings, because the question you ask rightly is how much do you need to see, and do you need to wait to see the really hard evidence, and how long would that take? Do you need to be more confident that that will happen, put in the future tense? And that will be a judgment. And it's the judgments we always have to make in monetary policy. And I just come back to the point I made earlier. In some ways, this is taking us back to what I might call a more normal state of affairs in terms of judgments we have to make. We're not talking about big shocks here, but we are talking about how things pass through. So my decision sort of thought process, it's not a question of saying I have to see the evidence, on the page, in the actual numbers. It is a matter of being more confident that we think it's going to come through.
John Paul and then Darshini.
Hello, John Paul Ford Rockhurst from the Daily Mail. Couple of things, please, Governor. On the balancing that you and the rest of the committee have to do in relation to the slowing of the economy, the rise in unemployment compared to keeping down inflation, it seems that you're saying that a rise in unemployment to 5.3% is a price worth paying to keep inflation on track. Is that the case? How high would unemployment have to go before you can start to worry that you're out of kilter with that balance? Second question, going back to the Epstein-Mandelson theme, you mentioned your shock at the cover-up in particular as to what happened. What should the consequences be in terms of, A, should there be more transparency, great transparency now as to what did happen, and especially in terms of the appointment of Mandelson back to government and back to as US ambassador? Does this cast doubts on the judgment of those involved, particularly the Prime Minister?
I don't want to knock very firmly on the head the suggestion that in the Bank of England we think unemployment is a price worth paying. That's not. It's an old question. I've known it for years. That is not the case. We do not welcome unemployment. Let's be very clear. Our job, and it's the job that Parliament has given us, is to hit the inflation target and to do that, in a sustained way, and we will do that. But I do not for a moment, sit or go around anywhere saying, and 5.3% unemployment is a price worth paying. It is not. And none of us want to see unemployment any higher, frankly. So just to be very clear on that. On the second question, I am not going to, in any sense, pass judgment on anything that has happened in terms of the sort of precise who knew what when in recent times. My point was a much bigger one, and it's a point that I think we all have to share in, which is, how did this happen? Now, going back to the point about 2008, 9, what do we learn from that? I think we do learn from that there are, times in which, things seem to happen, lobbying happens, which has, frankly, ethics attached to it, which, I do find shocking, frankly. I do find shocking. I worked very closely, in fact, all three of us worked very closely, in that we were all involved very much, but I was very much involved in the financial sector measures. And I will say this, one of the things, and I think we all three of us can say this because we all knew him, to see those pictures of Peter Mandelson with Alistair Darling, Alistair Darling was doing all the right things. And he was doing them, in my view, I knew him very well, we all knew him very well, with a thorough sense of honesty and decency. And he can't speak for himself today, sadly.
Darshini and then Francine.
Thank you. Governor, as you say, there is some good news in the sense that inflation appears to be heading back towards target. If I may, two areas which may not be quite so good news. First, that increase in your unemployment forecast. How much of that, in the bank's reckoning, is to do with the impact of NICs and, say, policies such as higher minimum wages? Because the agent survey seems to suggest that there's been more of a hit to hiring than had been expected. And also, even though you say there's scope for rate cuts this year, the Financial Policy Committee's report on December pointed out there's perhaps close to 4 million households which are still set to see higher repayments because rates remain higher than they were just a few years ago. So what's your message to them? Because, this is going to catch many unaware. Thank you.
I think the next question actually goes back to Jeff's question, really, actually. And Claire made the point that, the response to the NICs was, there was quite an obvious, strong element of sort of, in a sense, to use this term in the sort of more scientific sense, behavioural response, in the sense that there were options for companies. And I think, and again, as Claire did, I'd recommend the chart in the agent summary, that, as the year went on, probably more of the adjustment was being made on the employment side and on the labour market side that we saw. I think, our view, and we've said this in the report, is that, that is now sort of passing through. So, that next effect is now passing through. It's not something we expect to be persistent in terms of the change. I think that's, how I would, in a sense, summarise the next situation. I think we want to come in on.
Yeah, sure. I mean, look, the unemployment is. There's a whole set of things going on in the labour market, of which there was obviously one. I mean, actually, what we're seeing, and we look at this obviously incredibly carefully, is perhaps less on the hiring side rather than large numbers of workers being let go. So you're seeing a sort of a balance there, and of course we're watching it incredibly carefully, including all parts of the labour market, and thinking about what could be happening. We're seeing particularly high numbers, for example, on young persons' unemployment at the moment. Those sorts of things. We're watching all of that and trying to understand there what's going on. So of course, these changes in the labour market last year were a part of that, but also this is the sort of economic cycle playing through.
I was going to come in on the second.
Yes, I was going to say the second.
Yeah. And you're absolutely right to quote those figures from the Financial Stability Report. That obviously reflects the structure of the labour market now, of the mortgage market now, that people are, we have many more fixed term mortgages, so people are still having to refix at higher rates. I mean, it does come back, I think, the main message is, and it comes back to the kind of central message of everything we've put out today, and Andrew said it, that we need to not just see inflation get back to target, but our job is to make sure that inflation stays at the target sustainably. That's what we do to contribute, from the Monetary Policy Committee perspective, to monetary stability. That provides the best foundation then for householders to make decisions, to plan ahead, businesses. So that's kind of comes back to our job.
It also illustrates why the judgments we have to make on the restrictiveness of policy are so difficult, because the mortgage market, as you rightly say, Darshini, has changed a lot, and it takes longer for these changes to now pass through.
Just two quick last ones, Francine and then Maurizio.
Francine from Bloomberg TV. Governor, to what extent is the political risk at the moment in the UK, and therefore the different political, policy uncertainties, widen the ranges in which the MPC has to take into account?
I can assure you that we don't spend our time discussing political risk, actually. That's not a factor that we discuss. I mean, and let me reiterate something we've said many times. We obviously take financial market prices as a conditioning assumption. So to the extent it's in there, it's in there. It's not something we explicitly discuss.
Last one, Maurizio.
Hi, Maurizio Alencar, CCAM. Given that the story of the last 3 months have been around leaks and new leaks around Epstein and Mandelson, do you have confidence that there are enough safeguards in place for officials in high public office around market-sensitive information and how that is shared either within institutions but also obviously with other market participants? Thanks.
Well, there is a very, very clear and unambiguous legal framework in this country for dealing with market-sensitive information. There's no question about that. I've been involved in it in several of my roles in operating it. And I think the most appropriate thing is that this matter is now in the hands of the police, and it's not for us to second-guess what they do.
Great. Thanks very much, everyone.
Thank you.
The Bank of England has kept interest rates on hold in its latest decision. The move means it stands at 3.75%. It comes after inflation bounced back in December, rising for the first time in 5 months. The bank last cut its rate in December from 4% to 3.75%. Following today's announcement, bank officials signalled that further cuts are now likely later in the year as inflation falls back to the bank's 2% target faster than expected.
Recent developments provide more confidence that inflation is on track to return to the target soon. But we need to ensure that inflation falls all the way back to the 2% target and stays there. So today we've held bank rate at 3.75%. Now, despite all the uncertainties in the world, and we don't underestimate those, we are not currently facing a situation in which monetary policy is being hit by big new shocks. The world economy was more resilient last year than we had expected. So our course remains the same. It's to get inflation to the 2% target and for it to remain there and to put the big external shocks that drove inflation up behind us.
Sky's business and economics correspondent Paul Kelso joins us now from outside the Bank of England. So, Paul, what does it mean for the economy, but also for those of us with mortgages or savings, or possibly both?
Yeah, it means that there's no good news for now, but it's coming. The messaging here, while there was no action today, they've held rates at 3.75%. That was the rate that was set back in December at the last meeting. Actually, rates have been coming down since August 2024. The expectation wasn't that there would be any movement today, but the signalling, I think, has got stronger today from Andrew Bailey. The bank in its minutes talks about a further rate cut being likely, and while he won't pin himself to when or by how much, certainly the market expectations of a rate cut in the spring. There's another meeting in March and then one at the end of April. One of those, that has increased as a result of this, basically because inflation is coming down faster than the bank thought, in part because of measures in the budget, including cutting energy bills. So there is good news pending, at least for, and we may be getting, to balance that, maybe getting to the bottom of the cutting cycle. That's the other thing that's really come out of today. Somewhere below where it is now, and 3% feels like where the bank will probably pause, thinking inflation will hold at 2%. Perhaps more interesting in the context of what you've been discussing all morning regarding Jeffrey Epstein and Peter Mandelson and the crisis the government is facing is Andrew Bailey had a front row seat on many of the events surrounding Peter Mandelson. He was chief cashier at the Bank of England back in 2008. He was also then head of the Financial Conduct Authority, which sought action against Jess Staley, the chief executive of Barclays Bank in 2019, who had a very close relationship with Jeffrey Epstein that he didn't disclose. Peter Mandelson, of course, back in 2008, these revelations that he was sharing market-sensitive information at a time banks and governments were struggling to shore up the financial system. That gave Andrew Bailey a front row seat and made it worth asking what his reaction was to what we've heard over the last few days. This is what he said.
We've seen revelations in recent days about Peter Mandelson's conduct while business secretary, his contacts with Jeffrey Epstein, the sharing of sensitive information with financiers at a time when governments and indeed central banks were working to deal with the fallout from the financial crash. You were at the Bank of England at the time. Have you got any reflections on that conduct and what risk, if any, it posed to the stability of the financial system at the time?
I mean, I am shocked by what we're hearing. You probably remember that around a year ago I had to go and give evidence in a legal case involving this whole issue, dating back to my time at the FCA. I'm afraid all I can conclude is that, I was obviously very happy to do that. It's my duty. That again, it was having to sort of, in a sense, push back on the lies that we were being told consistently. I am shocked by what we now learn about what went on during the financial crisis period. But look, let me just offer two reflections. And one really reinforces what I think the Prime Minister said this morning, that the most important thing in all of this is the victims. Everything else is obviously things that necessarily must be gone into, but we must not forget that the most important thing in this is the victims in all of this. The second thing I'll just offer, and I think this is, if you don't mind me saying, I don't want to sound pious, but this is for all of us. How is it that we live in a society in which this happened? And the cover-up happened as well. I mean, those are questions that we all have to ask, which, I think that is a very fundamental question that we have to ask ourselves.
Now, those comments from Andrew Bailey are interesting for many reasons. One, he's a central banker. He steers clear of political commentary at all times. He is independent of politics and wants to keep it that way. But plainly, his decision to make that comment, that he is shocked at Peter Mandelson's conduct, underlines the severity, away from the salaciousness and the appalling revelations about Jeffrey Epstein's conduct. There are some very hard, difficult questions about Mandelson's conduct as a minister at a time when the economy was facing really, really grave peril, not just here, but around the world. Britain was seen as one of the leaders in the recovery from that crisis, not least because of the relationship between Gordon Brown's government and the Bank of England, then led by Mervyn King, but with Andrew Bailey as a key figure. And his shock at that conduct suggests that was in danger of being undermined. I have just heard him give a further answer on this subject, and there was another element to it that was fascinating. He mentioned Alistair Darling, Chancellor at the time, died in 2023. Bailey reiterated his shock at the conduct that has been alleged of Peter Mandelson, but then pointed out he has felt deeply sad to see Alistair Darling, who he said was working tirelessly to try and steer a course through that crisis, seeing photographs of him sitting next to Peter Mandelson, not knowing what was being leaked behind his back, and he described that as very sad that a man who now can't answer for himself was being undermined in that way.
Paul, thank you.